So imagine this. Imagine you're looking to dip into the market and start investing. Given how badly the market is performing, one of the questions you're probably asking is, how long do you wait before you buy, and how do you know when stocks can't go down any further? So I think there are probably two ways to look at this, or I should say there's probably a few ways to look at this for stocks that are temporarily going down. You can say, I'm going to buy this stock because I like the price it's trading at and the safety of a margin it gives me, which is a classic way to invest based on value. You can say from here on, even though it looks like it's going down, I'm okay with it because I'm sure of my margin of safety. I know that things will eventually work out in the end. And eventually, I'll have the option to sell at a profit when the valuations get back to normal. And that's one way to look at it. Now, the other way is to take a Warren Buffett approach, which is buying a stock that's below its intrinsic value. Now, and this is even more an opportunity in the downtrend, because once you find a stock that's in a downtrend, if it falls a little bit more, you can pick up even more shares. And you can repeat this process as often as the stock is below its intrinsic value. Now, this is known as averaging down. And what you're doing is you're basically getting a lower cost basis on the stock that you're going to be buying anyway. So you can just keep adding to your position, and the lower it gets, the more shares you can get in comparison to where it was before. Now, the one thing you have to be mindful of with this approach is to make sure you're not chasing a falling knife and getting into a situation where the company is actually doing poorly and you're making a mistake. Now, how do you avoid this? Well, there isn't really a perfect way to do this, and some of it actually is a matter of experience. And some of it actually boils down to doing your own due diligence, as well as believing that the strategy that you've been following will continue to work for you. Now, another thing to be wary of is the likelihood of the business shutting down. Now, you need to be confident that the company that you're buying is resilient enough to withstand turbulent times and stay in business, even if the stock price takes a beating. Now, you have companies like SVB, which could not weather the liquidity crisis and they ended up going under. And then on the flip side, you have a company like Amazon, for example, which, even though they've been reporting lower than expected earnings, are still cash heavy and are able to run with no impact to day-to-day operations. Now, it's always a good idea to watch out for companies that are deep in debt and companies that have declining revenues, as this is usually a sure sign that a company is in trouble. So how can you tell when a company is actually going out of business, or if its stock is just being sold off too quickly because people are scared? Now, there's no perfect answer, but I think you can probably use common sense to tell when something is short-term and when it's more about the future. I think these are some signs that, hey, this might be a really great undervalued company that's been beaten up, and it could probably take advantage of them to feel even better about the margin of safety. And the good thing about the margin of safety is that the bigger it is, the more times you can actually make a decision and be completely wrong. Again, let me rephrase that. The higher your margin of safety is, the higher your margin of error is, and the less likely that it is that you lose money on the stock that you buy because of it. So you should know that the cheaper something is, the more room for error there is. And even if you're wrong, you may have had some good reasons to be afraid. But then again, you bought the stock when it was so cheap that it can't really go down much further. So being able to buy this way can definitely be an advantage. So now you're probably asking, exactly how long do you wait before you buy, and how do you know that a stock won't go any lower? Well, you really can't make that call, and you just have to accept that. That's part of the risk of investing in stocks. You don't know exactly if the stock, or any stock, will go down or up compared to how you feel. Now, obviously, I personally think that the value of a stock that I buy will go up over time, because if it wasn't cheap and if I didn't think it was going to go up, then what's the point in buying it? Now, typically, seasoned investors have a list of stocks that they're interested in, but maybe that stock might be too expensive at the current price compared to their intrinsic value. So what they'll do is that they'll watch and they'll wait for the price to come down. And when the price is right, then they'll pull the trigger. Now, you can see how a company is doing by looking at their balance sheet and income statements and, reading through their earnings reports. So you can use the data from there to drive your investment decision. For me, I personally use a dollar cost averaging strategy once a month or more often if possible. And I'll look at a stock, make a decision, and go with it. And if it goes down, that's just a bigger dividend reinvestment that I can make, and I'll just keep holding and watching the stock and the company behind it, just to make sure that there's no red flags or warning signs. So I think it's important to understand the company and make sure that you keep track of what makes it risky, because there's no surefire way to make sure that your stock won't go down. And for me personally, like I said, if I like a stock and if it's in a temporary downtrend or uptrend, I'll buy it and I'll be comfortable with my decision because I've already done my risk and company analysis. So that's basically it. So you can overanalyze all you want, but Warren Buffett has said that if you keep it simple, look for stocks with a high margin of safety and growth potential, then the dividends should ideally grow over time. And I believe these are the things to look for. I believe that the temporary downtrends are just that, they're temporary. And in the end, it doesn't matter as long as you dollar cost average and diversify. Thanks again for tuning in. If you found this episode helpful, drop a like or leave a comment. And as always, I will catch you in the next episode. Peace.